So a happy 2020 to all you investors and traders out there. Today I'm going to take a brief look back and a long look forward as to what markets have in store for us all over the coming year. The last decade has rewarded investors handsomely, whether you've been in global equities, global fixed income, global credit. You've probably done quite well, to say the least. And these returns ultimately have been underpinned by a significant increase in corporate earnings, very much contained inflation, and of course, hyperactivism from the world's central banks. As regards 2020, the consensus very much is for more of the same, where the market's currently expecting further rate cuts from the US Federal Reserve, which in turn should give more wriggle room for other central banks to also cut. We're expecting, the consensus at least is expecting an increase in corporate earnings to be quite sharp, and inflation is expected to be quite muted. Well, you know, with a new decade comes new opportunities, but also new challenges, and I think it probably won't be quite that simple. For starters, if you look at the interest rate environment, it appears that the Fed, having cut interest rates 3 times last year, is probably done with its so-called insurance rate cuts. Inflation, whilst not taking off, is certainly creeping up quite steadily and likely to exceed the Fed's own target during the course of the year. So that all means that the tailwind from central banks that we certainly had last year is likely to be weak to non-existent. That in turn is also likely to mean that the earnings pickup that is currently being forced out there is probably going to be weaker than expected. And last but not least, part of that earnings forecast seems to be predicated on some resolution of the US-China trade tensions that we currently have. And frankly, at this point, there is little to no visibility on that at all. We're struggling with just a so-called phase 1 deal. So how does this drill down to the performance of markets? Well, I mean, it suggests that, it probably pays to have a reasonably proactive stance on equities. We're still going to see growth. We're still going to see economic growth. It's probably just not going to be quite as much as we expected. What does it mean in terms of where we place our bets within equity markets? Well, it probably means that, the current consensus that you should be in the sort of more pro-cyclical economies at this stage, you should be rotating into Europe and Japan, probably isn't right. You've got more cyclical exposure in those markets, more industrial exposure. As I said, I think the pickup in global growth and global trade is probably going to disappoint. So it's likely that's going to translate into relatively weak market performance. Markets such as Germany, of course, are going to remain particularly exposed, although other markets within Europe, such as Switzerland, are probably going to be relatively well positioned. But overall, you're probably going to be better off in a balanced portfolio with a tilt towards the US. On the fixed income market, well, as I said, I don't think we can expect much from the Fed. So that suggests to me that probably being out there at the end of the yield curve in 10-year treasuries and beyond is probably perhaps quite a dangerous place to be. It's a lot of duration, there's a lot of volatility that you're buying there. You're probably better off at the shorter end of the curve. And if you do want an insurance policy against volatility on the equity portfolio, then perhaps you'd be looking somewhere else like strategic cash, or indeed having a holding in gold doesn't look such a bad bet at this particular point of time. And then finally, perhaps we should have a quick look at currencies. I do think probably a basket of euros and yen are probably going to mildly outperform the US dollar. I expect the dollar to be sideways to slightly down overall. But I do also think that you're probably going to get some protracted weakness in some of the more commodity-exposed, trade-exposed currencies such as the Aussie dollar, Canadian dollar, and the Norwegian krona. So there's plenty to do there, plenty to think about. The last thing I'd say is, even though we do have geopolitical risk, I think that should be taken as a strategic opportunity. Obviously, you have to look at that within context. You wouldn't reflexively buy on dips, but you might have a few opportunities that opens up. So interesting year ahead, challenging year ahead, hopefully a profitable one for you and me. Cheerio.